ULTY feels simple on the surface, but it's anything but. Many investors misunderstand its fundamentals, leading to unintentional risk exposure. Now in this video, let's dive into the most common mistakes and what really matters. One of the most common ones is its distributions. ULTY, famous for paying out weekly distributions, and it's not actually traditional dividends. Now on this channel, and a lot of people invested in YieldMax ETFs, use the terminology of dividends just for semantics, but they're actually distributions. And this is a huge difference in terms of tax implications, because they can include ordinary income or return of capital, which is very different than a qualified or non-qualified dividend from a traditional ETF or stock. By mislabeling distributions as dividends, this can cause incorrect tax assumptions. ULTY distributions are mostly non-qualified and taxed as ordinary income or return of capital. So more than likely, eventually, you're going to be paying a hefty tax bill every single year from these distributions. And it's very important to note what exactly return of capital is. Now, many assume return of capital means you're getting your own principal back with no implications, and that is just plain wrong. Return of capital actually lowers your cost basis, and if that basis hits zero, all future distributions becomes taxable capital gains. It doesn't represent fund safety or performance. It may simply reflect how distributions are categorized. A lot of times with traditional stocks or ETFs, return of capital is simply just paying back your own money in the form of a dividend. While that may be true in those cases, with these high income ETFs, they're a little bit different since they're selling covered calls. And one example that we can give to you guys is if the underlying stocks on one of the covered calls that they're selling options on, say they have a MicroStrategy covered call at the $410 strike, and they own the underlying MicroStrategy. If this stock goes to say $415, then we're going to be having a realized loss on the covered call. And while that may be a loss on paper, we are shareholders of MicroStrategy, which is actually bullish, and you're going to have a gain in that case. But that's not going to be realized. So the distributions that they're paying out is going to be in the form of return of capital, which is going to be very good for deferring your taxes. And speaking of taxes, people often just simply reinvest their distributions without setting aside any cash for taxes. And with these high weekly income ETFs, especially ULTY, which is paying about 70%, we can take a look at the distribution rate, which is about 80% actually, since it's been paying out 10 cents per share. The tax liability can pile up very quickly, especially if you're in a higher income bracket. So it's always good to check whether the latest distributions that you're receiving are return of capital or income, because then you're going to be paying taxes on those distributions. Now, the third mistake that I see a lot of people making is going to be skipping core ETFs. ULTY isn't designed to be a core portfolio holding. It's very tactile and income focused and not very growth oriented. What people are looking for is a stability in the NAV as well as consistent dividends, not necessarily dividend growth, because this is designed as an income vehicle. ULTY's strategy is high volatility focused and benefits from short-term option premium, not long-term alpha. And I see a lot of people in the comment section below having tens of thousands of shares of ULTY, as well as other YieldMax ETFs such as MSGY. That is such a large portion of their portfolio in these high income strategy ETFs. So relying on ULTY alone instead of building a base with broad ETFs such as the S&P 500 index, VOO, very popular one, very low expense ratio of 0.03%, but you're tracking the top 500 companies in the United States, and it's been a safe bet to just buy and hold for the long term. or even QQQ, the NASDAQ index, if you're more growth oriented, in order to have that diversification in your portfolio. If something happens to ULTY or something happens to YieldMax, you do want some other funds to rely on, and you can always fall back on your core portfolio holdings. If you want something a little bit safer, a little less volatile than VOO or QQQ, SCHD is going to be that third pick, in my opinion. It's going to be a dividend grower, not going to grow as much in capital appreciation, but it's been growing its dividends consistently, and it's one of those popular ones, just buying and holding. And the best thing about this ETF is you can sleep at night. And speaking of the overall market, we will use the S&P 500 as an example. If we take a look at the past few months, we are in a massive bull market. So people are going to misjudge market exposure, which is going to be our next misconception. And while ULTY does have those protective puts as hedges, you're still going to retain full exposure to downside risk. And a good example of that is when it switched to weekly, which was during March 13 of 2025. It went on a run all the way up to about $6.80 per share, but we had Liberation Day in April and it dropped a full dollar down to $5.45. But since then, since the perspective change, it has been doing very well and very stable, especially in this bull market, which is something ULTY has not previously done even in a bull market. So while things do look ugly, the perspectives change and the strategy has worked, as it has been stabilizing the NAV when market conditions align. So that is probably the biggest risk I'm seeing a lot of ULTY investors make. They believe that high yield means little to no risk, so they're putting their full portfolios, they're even taking out loans using margin to buy more and more ULTY shares. So with all of these misunderstandings about ULTY out of the way, here's what you should do instead. The first one, of course, is going to be reserving cash every single week or every single month when you receive your distributions for taxes on those distributions when tax season comes around. And one of my favorite places to park that cash is going to be SGOV, the iShares 0 to 3 month Treasury Bond ETF, which pays higher than a high yield savings, which is about 3.50% at Capital One. So you're getting almost a full percentage more than a high yield savings. And the only things that this ETF holds are short-term treasury bills. So you're not going to lose any money. And one of the best things about this ETF, it does pay out monthly, just like a high yield savings, but you're exempt from state taxes. You're only going to be taxed on the federal level, which is just your ordinary income tax. So you pretty much have to treat ULTY as a satellite or income sleeve and not your entire portfolio. And you want to track the fund's NAV pretty closely, as the yield isn't the whole story, as well as diversifying with core ETFs such as the S&P 500 index or even the NASDAQ or SCHD as some of your core holdings. And you can even place some of the dividends that you're receiving from ULTY into others, such as SPY, which is the NEO's S&P 500 High Income ETF, pretty well in the NAV, paying out monthly with a high distribution rate of 12%. And it's also very tax efficient due to tax loss harvesting strategies. QQQI is going to be the same strategy, but on the NASDAQ 100 index. So it's going to be a little bit more volatile. In return, you're getting a higher dividend yield of 14%, of course, paid out every single month. Now, I'm a huge fan of these NEO's high income ETFs. And while they're not as high yield as something like the YieldMax ETFs, it's still a great position to have for something a little bit more stable and you can rely on it. Now let's move on to our final thoughts. This ETF is absolutely amazing. It's my number one pick currently for the weekly income ETFs. One of the highest yields for YieldMax for those weekly payers. and it's performed absolutely amazing inside of my portfolio. But we don't know how this ETF is going to perform in a bear market, and that's something that any stock or ETF is going to experience. What happens in a bear market? Of course, the underlyings are going to go down, which in turn ULTY will drop in share price as well. But ULTY can produce strong income for a certain type of investor, but only if you know exactly how it works and how it doesn't.